All right, let's get right into it. Today, January 26th, 2026. The global markets were, well, they were all over the place. We're going to break down a new analysis that says it's figured out what's really going on, using a fascinating mix of old school economics and some pretty high-tech quantitative modeling. So, right out of the gate, you see this really weird split. The Dow Jones? Up. Looked pretty good. But then you have the semiconductor sector, the one that's supposed to be driving the future, and it's actually down. This wasn't your typical day, was it? It wasn't just a simple risk-on or risk-off situation. Something else is definitely brewing under the surface. And that brings us to the big question, right? Is this just a blip, a bit of market noise, or are we looking at the start of something totally new, a whole new economic paradigm? Well, this report, it's not hedging its bets. It argues, and pretty forcefully, that we're at the start of something big. Okay, so here's the game plan. We're going to start with a global snapshot, then dive deep into the U.S. market. After that, we'll hop over to Europe to see what's happening there, and then tackle the huge surge we saw in Asia. Finally, we'll look at a pretty cool quant strategy for 2026 and finish up by asking, are we in a new paradigm? All right, let's kick things off with Section 1, Decoding the U.S. Market. And the subtitle here really says it all. It's a story of confidence versus caution. So take a look at these numbers. You can see that split performance crystal clear. The Dow, the Nasdaq 100, the S&P 500, all green, all looking solid. But then, boom, there's the semiconductor index, the SOX, lagging behind in the red. So what's propping up the rest of the market? Well, the report says it's all about some just-released economic data that was, frankly, kind of incredible. And here's the fuel for that fire. Check this out. Durable goods orders shot up 5.3%. That was a huge surprise. Nobody really saw that coming. And on top of that, you've got Michigan consumer sentiment hitting a 5-month high. People are feeling good. So when you put those two together, it's no wonder the market is basically saying there's a 97.2% chance the Fed is just going to sit on its hands and hold rates steady. But here's where it gets really interesting. The report argues this isn't just about spreadsheets and data points. It connects everything to this fascinating idea called social mood theory. Now get this. The theory says that collective public feeling, that positive consumer sentiment we just saw, isn't the result of a good economy. No, it's the cause. The good mood comes first, and that's the real fuel that drives the market up. Okay, so if the mood is so great, why did the mighty semiconductor sector trip up? What's going on there? Well, the analysis introduces this concept it calls the innovations trap. The idea is that the industry is so focused on pushing for technical perfection, the next big thing, that it's actually creating these fragile supply chains and market friction. So even though demand is strong, these internal pressures are temporarily holding the whole sector back. Okay, now let's hop across the Atlantic. Section 2, Europe's diverging paths. And this is a perfect example of how different national policies can lead to totally different outcomes in the market. And what a mixed bag it was. You had the UK and Germany just creeping up, getting a little boost from some policy expectations and really strong numbers from heavyweights like Bayer and SAP. But then you look at France, and the CAC 40 was the odd one out, actually slipping into the red. So why the dip in France? Well, according to this analysis, you can point the finger directly at one specific area, the luxury sector. There was some uncertainty swirling around big names like LVMH, and that was literally enough to drag the entire index down. It just goes to show you what a huge, outsized impact that single sector has on the French market. But honestly, the biggest story of the day, the one that everyone is absolutely talking about, happened over in Asia. Get ready for this. Section 3, the Asian market surge. Just look at that number, a 7.09% surge in one day for South Korea's KOSDAQ index. I mean, that's not just a rally, that's a rocket launch. The report actually calls it an explosive transition of social mood. It's like we're watching a fundamental psychological shift in the market happen in real time. And just to put that into perspective, take a look at this chart. It really shows you how absolutely massive this move was. The KOSD CAG didn't just beat the competition, it left it in the dust. It completely dwarfed its bigger domestic brother, the KOSP, and even made the really strong day we saw in the S&P 500 look, well, kind of small. So you gotta ask, what on earth caused that? Well, the report says it was a perfect storm. You had a government with a clear, ambitious policy, this COSDAC 3000 plan for digital assets, and you combine that with that massive explosive shift in social mood. It was the right policy at the exact right moment of investor excitement. Meanwhile, it wasn't all fireworks in Asia. Over in Hong Kong, the tech giant Baidu actually dropped more than 3%. But, and this is a big but, the report's quant model thinks this is just a temporary pullback. It's actually giving an 82% probability of a rebound to between 175 and 185 Hong Kong dollars in the next 2 weeks. Why? Because it thinks the market still hasn't priced in their new Ernie 5.0 AI and a big chip spinoff that's coming. Okay, so with all this analysis, how do you actually translate that into a strategy? Let's dive into Section 4, a 2026 quant strategy, and see what the report's model suggests. So, the model crunched the numbers and came up with this sample portfolio allocation. And you can totally see the themes we've been talking about, right? It's heavily weighted towards U.S. growth at 35%. Think AI leaders. And then look at this, 25% in Korean momentum, trying to ride that huge wave in their tech and biotech sectors. The rest is rounded out with fixed income, alternatives, and a little cash. But the strategy isn't just a set it and forget it kind of thing. It's all about watching the key technical signs. The report flags 3 things to keep an eye on. First, the COSDAX RSI. You gotta watch that to see if things are getting overheated. Anything over 80 is a warning sign. Second, the Nasdaq's MACD to make sure the trend is still strong. And third, a really specific level in KOSPI futures, above 735.00, that could trigger a massive short squeeze. All right, let's bring it all home. Section 5, what does this all add up to? Are we really in a new paradigm? The report has a pretty poetic name for it, the Great Waltz of the Market. And that's the powerful metaphor the report ends on. It's saying we are now entering the Great Waltz of a historic bull market. The idea is we're moving past the old, clunky economic models and into this new fluid phase, one that's driven more by the rhythm of human psychology and these big innovation cycles. And that right there is the key takeaway, the core message of this whole analysis. To really get what's happening in the market in 2026, you can't just be an economist anymore. You have to think like a sociologist, watching the social mood. You have to think like a technologist, tracking these waves of innovation. The game is changing, and it's all about that interplay between mood, innovation, and policy. And that leaves us with one last kind of mind-bending question to chew on. Are we thinking about the market all wrong? I mean, if this report is right, if social mood really does come before the market moves, does that completely change how we should interpret every single piece of financial news we see from now on?